Budgeting can feel like a arduous, time-consuming, confusing, and relatively unhelpful process if you don't have the right tools in place and the right methodology to get it done in a fast and accurate way. So let's jump into how I would help you, how we would help you here at Bookkeep Prosper to create your budget and the tools we would use to make it really insightful and to adjust and keep it relevant as you move throughout your year and you look into the future years as well. So first step in creating a budget is understanding what your objectives are, because you can create a budget and say, pick any numbers you want, or just look at the historical data and say, hey, are we on track? But really the point of a budget is to help you stick to a plan so that you can meet your short and long-term goals for the business. So the very first thing we'll do is go through a process where we look and see, hey, what do you want from this business? What are your goals? Now, is it merely just to get back more time for you? Is it to bring back more time? Is it to make more money, have more profit in your business? Is it just to increase the revenue? Or do you have other goals in mind that you want to get this product launch, or you want to do this other aspect of your business that you've been working on? You want to see that through to completion or to launch, whatever it is. We'll first define those objectives. Now, defining the objectives doesn't necessarily mean we have the pieces of how you'll meet that objective, but that gives us a target to look at. Now, if we were looking at that, say, in terms of looking at a financial goal or something like that, one of the tools we'll use is Fathom. And so here's an example of how we might use this. So say you wanted to increase your gross profit, and say you wanted to increase it about $100,000 over the next year. So we could change this to, let's just say this was 760. And go. And so what we're looking at here is a goal, the starting bound, starting where we are and what we want our goal to be here. And so in order to achieve this goal, we can take a look at, say, hey, here's what we actually might need to change here. If we can increase the price by 6% or 6.7%, then what we can do is we can change that price, and that's going to bring us in more money because we're going to have more profit. We'd also have to tie that in with the revenue. So this is sort of one way to look at all of this, but what we'd say is here, okay, well, what if we could only increase it 3% or 3.3%? How are we going to get to our goal? So just by increasing the price by 3% of our product, we can already get us to $708,000 of gross profit. But let's say our volume is going to decrease slightly because we've increased the price. We're not going to sell quite as much. That's going to bring us back down. And so in order to do that, then we're going to have to decrease our cost of sales. So if we're going to actually meet our goal, right, we can adjust this and see where we need to be and say, hey, that's going to be our goal. If we can reduce our variable cost of sales by 7%, then we're going to actually meet our goal. So in some ways, if we're having set financial goals here, we can guide you through, hey, how can we adjust this? How can we help our gross profit? Or you can say, our operating profit. Say we want to change that. So what we need to do is say, hey, we're going to decrease our variable expenses. And if we're able to do that, then we can just increase our price some. And if we're able to increase volume, then we don't need to change anything else, right? We've been able to decrease our variable expenses somewhat here, and then we can change some of these other factors. But we can play around with these numbers and show you what you'll need to change in order to actually meet your goals. So that's the first thing we'll do. And now if this is related to time-based, we put other factors in here. But the point is to have a plan moving forward so that we can actually base our budget on something that's accurate. Now, the next step here is to gather historical data. Now, what we'll use Fathom to do here is we'll actually jump into your forecast here. And what we'll do is we'll automatically pull in your historical data from QuickBooks or whatever accounting system you're using, right? We'll pull that data in so we have all the relevant data going back historically here. And what we can do is then pull that into the future, right? We can make some smart predictions here based on what your sales are going to be. But we're gathering that historical data and we're setting the specific and realistic financial goals. Hey, we're going to raise, in order to meet this goal, right? We're going to, say you want to get back your time. Like, hey, we're going to spend more money on staff. We're going to hire a couple more people so that we can really leverage them and get some of these tasks off your plate and onto your team's plate. So we could say, hey, we expect to have some increased expenses. So we'll gather historical data, and this is an easy way to do that here in Fathom. It happens automatically with a click of a button, and we have that here to analyze. And we're setting those specific goals. Now, next we'll estimate that revenue, right? So we're setting our revenue. So we're saying if we're planning to be where we was at the same place we were last year, or if we're planning to increase month over month, we can take a look at what those goals are, and we can plan them here into your budget. So after we gathered that historical data, we set the goals, we planned out your revenue, we're planning out your expenses, and so we're looking at a historical basis, what's going to kind of continue the same and what's going to change. Now, we also need to factor in non-operating and capital expenses. Now, those would be things like you're going to purchase new equipment, like a new truck, or you're going to renovate some of your facilities. You might have investments in the business that are not necessarily operating expenses, the normal day-to-day. So we're going to baseline your operating expenses, then we'll add in those non-operating and the capital expenses. Those might be interest payments and taxes, interest payments on the loans or any financing you have, and then estimated taxes you'll end up paying. We're going to factor those into your budget as well. Next we'll calculate your net income. So based on what we've projected there, we're going to be calculating your net income here. So we might be looking at your gross profit, cash on hand, but we'll be able to look at this straight away here and look at it in sort of a live view as well. Now, after we do that, we're going to allocate resources to sort of achieve those goals you've set. So this is where you can get really more specific departmentally and say, hey, in this department, here's our baseline expenses, here's what we have in surplus, or here's what we're planning to be with our finances, and here's where I'm going to refocus my money, or here's where I'm going to adjust to actually meet those goals that we set for the business and make sure it aligns with our budget and with our goals. Once we've got all that set, it's pretty much our plan here. Now, one of the things I'd like to point out as well is that I like to do when going through the budget process is actually putting together sort of our baselines. That here's the things that we know we're going to spend. We have to spend the money on insurance. We're going to have to pay rent. Here's our salaries we have to pay. But what we can also do is we can put together a roadmap here, and where we can add items here to this roadmap, such as we're going to we need to purchase a delivery truck, and we've planned that for September. But what we can do here is, if we're looking at our cash on hand and how that's going to change over time, we might have to say, hey, you know what? We can't actually purchase this in September. We need to push this out. What we can do is we could slide that around and move that to a later month. Or you're going to hire this junior staff member. And let's say that specific one, like, hey, we did plan to do that in October. We actually have to move this out to April because we don't have the cash flow that we need yet. But we have these business roadmap items of plans we're going to put in place, and we can actually adjust those and move those to the month, and you can actually see the impact when we look at your financial reporting here of how that's going to impact your bottom line, your finances, your cash flow, etc. And if there's, say, hiring a junior staff member, we can look at this and we can say, what's going to happen here is we're going to the salaries and wages is going to increase, and that's going to change our cash and cash equivalents, and we'll have some tax liabilities. But we could actually add in here too that, hey, we are going to be able to add in more sales here. Not in the first 3 months, but after the first 3 months, we might expect to start getting some type of a return from this staff member as they grow into the role, or have some returns on this as well. So we can plan out, hey, here's that sort of that training period, and here's that returns period where we start to gain some returns on that new team member. Now, having a budget is great, but if you're not actually reviewing it and adjusting it as you go out through the year, then it can stop being relevant. So what we like to do here at Bookkeep Prosper is have an ongoing forecast. So we'll put in a budget and we'll plan out a forecast here in addition to sort of a set budget, like here's our plan for the budget and are we meeting or exceeding that. We'll also have an ongoing forecast, which is going to update monthly with the live actuals. So what we can do here is we can have this account update with the previous month, and so we can see, hey, here's our actuals, and here's what we have projected based on the budget, or here's what we have projected based on what we have planned. So any things we put in here, like hire a consultant, purchase a delivery truck, these can be added to your forecast, as well as things like, okay, hey, we had budgeted this much for insurance, it renewed partway for the year, and it had a higher the insurance increased more, the premium increased more than we had been expecting. So let's factor that into the forecast so that our actual forward projection is actually more accurate than it would be if we just relied on the original budget we made. So adjusting that throughout the year and reviewing that as we go is really important to make sure that you have an accurate picture of where you're headed. Lastly, just incorporating a little bit of flexibility here. So if, hey, we want to reach this goal, let's not plan wire down to the wire. Let's say, hey, here's where we can plan different scenarios. And we can say, actually, we have a best case scenario, we have a worst case scenario, and if we only are able to do 120-day collections, here's how this is going to change our numbers. So in each of these scenarios, we can actually graph these out, and we can look at the reports here and look at the forecast analysis here, and we can look and see where are we going to land here. So we can see the business plan, things we have in the business plan here. We have micro forecast analysis here, how these items are going to play out. And we have also a revenue forecast here for these different items. And we can look at our cash flow charts of, hey, here's our cash flow, and here's where we're projecting to be over the next bit of this year, and our cash and receivables. So we can actually project these out and see these in a format that's easier for you to see, hey, how are we going to end up? Are we going to be profitable? Are we going to end up where we need to end up? So those are the basic steps here. Now, again, just to reiterate, we need to understand the business objectives. We need to gather the historical data. We need to set the specific and realistic financial goals. Then we'll estimate your revenue, project your operating expenses. We'll factor in any non-operating expenses and capital expenses like taxes, like insurance. Or not insurance, but like taxes and like interest, and any investment you might do in the company in terms of equipment. We'll calculate your net income, and then we'll try to align that and allocate those resources as additional resources, or make any changes that we might need to really focus that to achieve your goals. And we'll monitor and control your budgets. We'll review it on a monthly basis and look for changes in your projection that might factor in, or new plans that arise or develop over the course of the year. We'll review and adjust it during that period, and be open about the communication and collaboration between not only us as sort of trusted bookkeepers and consultants here for this task, but also with your team, factoring out, hey, here's where this budget is. Are we on or off budget? Are we overspending? And having those controls, having something to measure against so you can actually manage it. Keeping that budget aligned with your strategic goals, incorporating your flexibility, and then continuous improvement. Learning from each iteration of the budgeting process to make the next one better and more accurate. If you're interested in learning more about how we can help you with your budgeting goals, click the link here to schedule a discovery call. I'd love to chat with you and see what your goals are and how we can help you to achieve them.